We're back, and it's time for Ask Annex in the studio. Fred Coleman, CFP and a wealth manager at Annex Wealth Management. Hello.
Danny.
Matt Morzy is Director of Research, also a CFP at Annex Wealth Management, part of the investment team. Welcome back.
Hey, Danny.
First question, not sure if this is the right place to ask. Have your clients shared any feelings of grief where they miss working, maybe not the work so much, but friends at the company or a particular place of, quote, busyness they enjoyed?
This is the perfect place to ask because we talk to these people all the time. We focus so much on the investment and retiring, investing in money, but retiring is far beyond that. What I see a lot of times, a lot of people are tired of working, when they get close to that age. And then once you do retire, usually go through like what's called like a honeymoon phase, but that only lasts like 6 months, where you're really tired. You've done all the resting you can do for that first 6 months. But then you're going to need something else to do. Mm-hmm. You start needing that sense of fulfillment. And at that point, you just need to reassess and readjust. Some people do go back to work, but you were working because of money for the most part. So now that you have your money, your financial situation taken care of, it's time to start doing things that you love without the pressure of needing that paycheck. We do see that. And that's why all the time we see, hey, it's really important to retire to something and not just from something.
Yeah, I think that's really important because you really do have something that you need to retire to. It's not just going at home and just not waking up as early as you did and sitting on the couch and watching TV and stuff like that's going to get boring pretty quickly. But relationships matter, being around people matter. I think we really saw that during COVID when there was times where people had to isolate right away and just you could tell quality of life went down and the people missed the relationships that they have. And I think that is really important, whether it's people that you're spending 40, 50 hours a week with, every single week, you see them more than you probably see your own family, a lot of times too. So those relationships are a really big deal, but it's really important finishing up your time working, having something to transition to, volunteering, part-time jobs, hobbies, all that kind of thing is super important. What do you think, Danny?
We all operate at a pretty high tempo here.
Mm-hmm.
I know your department as well. I think I would miss that pace, and I don't have my thing yet. So that's why I'm still here. All right. It's Ask Annex question 2. Does net worth matter if my house is an illiquid asset? That's a great question.
Yeah, I think it does and it doesn't. I think from an overall net worth standpoint, it's really important to have it there. Can you go out and spend that money today? No, you can't. But having a solid, equity into your home is really important. It does provide a little bit of a safety net if something would happen. You always have the ability to sell your house and take the money out of it at that point in time to use it. At some point, you're probably going to do that anyways, right? You're going to retire and move and go to someplace else, or maybe you're a little bit older and you need to transition to, a different setting, such as assisted living or, different apartment housing. And the funds that you have built up into your home is going to be really important to that. I also think there's a really big psychological impact to it as well. My wife and I, we track our net worth on a monthly basis, and hopefully Zillow says that our house is worth a little bit more than it did before, but who knows how realistic any of those numbers really are. And you're making your mortgage payments, so your debt's going down a little bit. So that gap should hopefully be increasing and that equity increasing. And it feels good to see those numbers go up. But again, you can't spend it right away. So from a standpoint of, hey, I want to go and do this, or I want to go and do that, or expense comes up, that's not money that's going to be available for you to use. So I can see why somebody might, look at it maybe as a little less important than other parts of what they do.
Yeah, I agree. I mean, the big thing is it's not liquid right now. Where I've seen it really come into play is once people downsize. During retirement, a lot of people, you've got this huge house, but you're not going to be able to use all that off. It's just you and your spouse. So if you downsize, sell that, then a lot of people come up with a lot of cash.
Yeah, you're right there. But, one of the problems is the boomers are not selling those houses.
Oh, yeah. Right? You got 3% interest rates right now. So where are you going to go?
All right, let's squeeze this one in real quick. If the Fed cuts rates in September by 25 or 50 basis points, how would that affect money market rates? Would they go down by more than 25 or 50 basis points?
I think it's going to be pretty close. Those they're going to trend to be pretty similar to each other. Money markets really are just a collection of really, really short-term debt instruments. A lot of them are going to be treasuries that are maturing really soon. They're going to be really high-quality, low default risk because it's coming from the government. That's going to be the bulk of what's in there. So if the Fed cuts rates and now, a 3 months treasury, or a year, 2 years as they become closer to maturing, those rates are going to be impacted by that as well too. So I would say close enough. That's kind of a way that I would estimate that to go through. I think the things that are going to go down a little bit faster is banks who are reluctant to increase interest rates over time are probably going to be pretty quick to want to lower the interest that they pay on the bank account as well too, because there's less pressure for them at that point to try to be competitive with those things. So those are the areas that I think are going to be a little bit more sensitive to there. But a money market, I would say whatever the Fed's doing, I would just expect that it should be something pretty similar.
And Fred, this is a planning thing, right? Because people need to figure out what they're going to do with their cash once those rates do start to go down.
Absolutely. Is now the time to lock in some of those higher rates? If you're comfortable with that, 5% that you're yielding from a money market, is it time to look at a CD or treasury? We do know that we're probably at a peak interest rate. So now's the time to start thinking about what you want to do with that cash.
Fred Coleman, CFP, Wealth Manager, Annex Wealth Management. Thanks.
Thanks, Danny.
Matt Morzy, Director of Research, CFP at Annex Wealth Management. Thank you.
Thank you.